Is there a canary in the coal mine as far as the US economy is concerned? And does that canary come from a previous unloved section of the stock market? Now, I talk about stocks all the time and how we don't really pay much attention to them because most people just buy stocks just to buy stocks. However, there are periods when the stock market becomes a useful economic signal. And those periods are when stock investors see a rising chance of a traditional style recession. So when you get this case where stocks go up and then stop going up and then experience persistent selling, those are times when you really want to pay attention to them. And certain parts of the stock market provide more of a signal along those lines than others. And one of those, the canary in the coal mine, potentially the canary in the coal mine, is small cap stocks, something like the Russell 2000. Now, while the Russell 2000 experienced a real boom last year, especially with the election of President Trump and the idea that Trump's policies would be somehow business friendly, or at least just different from the Biden administration, small cap stocks soared at the end of last year until they encountered the late November, early December swoon across the rest of the stock market. Suddenly, the Russell 2000 has been having enormous difficulty to the point that the Russell, up until this week, has been facing the prospect of a technical bear market. It's well beyond correction. We're past 10%. We're talking about almost 20% correction on the index. And since small cap stocks tend to be more cyclically sensitive, it's something that we need to pay attention to. And then, by the way, we get more economic statistics that suggest the US economy has indeed stumbled dramatically here in 2025. The latest being the Conference Board's leading economic indicators. Like the stock market overall, the LEI and a whole bunch of other data, especially sentiment related, had absolutely soared last year, October and November in particular. But January comes around and then February, suddenly we're seeing not just the rolling over, we're seeing the rolling over accelerate to the downside. So small cap stocks, canary in the coal mine, the Conference Board's leading indicator, retail sales, and a whole bunch of others, not to mention the marketplace. Even the Fed's downgrade for GDP expectations and unemployment this past week at the FOMC meeting. It all adds up to something where we now want to pay attention to what's happening in equities. So, Steve, Mr. Van Meter, we've got equities that are suggesting there is maybe something here. And while there is, we can talk about dip buying and whether or not people are starting to bargain hunt in the marketplace. So far, we've seen potentially warning signs from the stock market, like I said, canary in the coal mine, small cap stocks in particular, that suggest shareholders and stock buyers are taking this recession's economic risk pretty seriously.
You're right, Jeff. Small caps are very important because they were supposed to be huge beneficiaries under Trump's second term. You got to think about his policies, right? We're going to have tariffs. It was going to supposedly drive domestic consumption. And for a lot of small businesses, this was exactly the news they wanted to hear. Now, going into the election, as we've talked about, the U.S. economy was slowing. And what did we hear from business executives, particularly big businesses who have a voice that in the media they can get out? They couldn't explain why the economy is slowing down. So they made up the excuse that, well, it has everything to do with election uncertainty. Consumers were just holding on to their cash, but just wait. If we get the right outcome, they're going to come out and spend like fire. And for small businesses that have been struggling at the margin, this was the exact news they wanted to hear. So when the election hit, of course, and Trump won, everyone said this is a perfect outcome. Business and friendly administration, people are going to spend big, things are going to roar, and small cap stocks just went vertical. But what happened after that is small businesses, despite their optimism going up right along with stock prices, they started to report that there was an issue, that people weren't coming in and spending as much. In fact, they weren't coming in nearly as much, and they started to be cash strapped. And what happened, next thing you know, the reports started to come out and validate that perhaps the consumers were not pent up, did not have a lot of money to spend in the economy, and now we're seeing a reaction in equity prices. And this is important because a lot of people just throw money in the major indices, the S&P and the NASDAQ. So when you watch the Russell 2000, I think to me, Jeff, it gives you a better pulse of what's going on underside the real economy, which is small businesses are struggling in a major way. And that's a leading indicator for where the economy's headed.
And one of the biggest ironies, right, Steve, is that a lot of that artificial high last year was based on tariffs. The idea that so much activity was pulled forward. And we've said this many, many times on the show. So much activity got pulled forward trying to beat the tariffs that it kind of created this this illusion that maybe the economy was picking up. So you had sentiment that soared ahead. Then you had a rush of activity, particularly related to manufacturing and trade. And it kind of felt like for a while there, oh, this thing is really taking off. But then you could sense that it really started to shift December into January, not because of trade wars, but because the other side of that front loading for tariffs. Then you had the payback period, which, as you pointed out, Steve, small caps are particularly vulnerable to economic conditions like this. You've got this massive loss of momentum that even stockholders want to buy stocks. Even they're now paying attention to it. There was an article in Bloomberg this past week that really, I think, it basically sums up all the ideas that you just said. But here's what it said. The Russell 2000 was one of the biggest gainers among equities after President Donald Trump won the US election in November. Investors piled into the group expecting it would do well in a protectionist regime given companies' largely domestic operations. Deregulation and lower interest rates were also expected to give them a boost. But that rally faded as doubts emerged about the impact of tariffs, not so much. And as worries grew that the US economy has started to cool. Smaller companies, typically less profitable and with greater debt loads than their larger counterparts, are usually the first to feel the pinch. And that's where you get the canary in the coal mine, because those are the riskiest companies and riskiest stocks to own. And so at the first thought that the US economy just might experience a recession, those are the ones that the first one, that's where you hit the sell button first. I want out of any of the Russell stocks. While they look good in November last year, suddenly they don't look so good here in February, March of 2025. Now, before we get back to the rest of today's video, I want to tell you about today's video sponsor. We talk all the time on this channel about the dangers the world is facing, trying to come to grips with the aftermath of the pandemic and the lockdowns, the difficulties associated with the supply shock and price illusion, not to mention still living in the shadow of the 2008 crisis. To put it mildly, there's a lot of systemic uncertainty. Now, I've recommended gold as a store value hedge for years. In fact, it's the ultimate error hedge. But if all you're doing is owning gold, you're only preserving your wealth, not growing it. And that's where today's video sponsor, Monetary Metals, comes in. With Monetary Metals, you can earn up to 4% in their leasing program immediately upon funding your account. And there are higher yields available to accredited investors in their bond offerings. The interest that you earn on your physical metal is paid in ounces of physical gold or silver, which you get in addition to any price appreciation from gold and silver while you hold them. So join the thousands of investors earning interest in physical gold and silver every month with Monetary Metals. There's a link in the description of this video that has all the information that you need. We thank Monetary Metals for their sponsorship, and now back to the rest of this video.
Yeah, Jeff, people went out of the Russell 2000 and into the mega cap because, hey, why should I buy something that's sensitive to the economy when I can go buy a stock from a company who's buying billions of dollars worth of his shares back? And maybe that will make a difference here. But you kind of mentioned something real important about small caps and the relationship to the real economy. A lot of people don't realize, it's something that I struggle with, is the fact that a lot of these small business owners were struggling financially in major ways. We look at inflation-adjusted retail sales, and they've been largely negative for 3 years. So we know small businesses have been hit with price pressure. They've got to give, their employees raises. Their rents have been going up, and they've been eating it at the margin. But yet their optimism was so high that things were going to change, that all of a sudden there was going to be this, deregulation push, and that was going to help, and the consumers were going to come out and spend. But their own reaction, they built up inventory here. But this other thing they did, and this is what really baffles me, is they were cutting the hours of their employees. So at the same time they said, hey, things are going to boom, their employees were saying, wait a minute, my paycheck's shrinking here. So after the election, as small businesses were like, all right, I'm all set to see everybody come and spend, workers all across the country were like, I don't have the money to spend. So that's the challenge I'm seeing here, is that if small businesses really wanted to see a boom, well, they would need to pay their employees accordingly. They're still not doing that. And now they're baffled of why the economy is not turning around, why their stock price is going around as they build up even more inventory that we know they're going to have to discount heavily in the near-term future.
We've talked about this before, right? Putting the cart before the horse. It's, business is supposed to pick up first, and then you start doing things with the labor market. You add more hours back, and you bring more employees if you get to your maximum capacity. And it's almost like everybody was expecting the opposite, right? They were still cutting workers, still cutting costs because margins were being squeezed, and somehow expecting that some way would just lead to business showing up. And therefore, then they would go backwards and start reversing some of those cost cutting moves. They bring back some of their part time employees and put them on full time. They might actually start hiring again, something we haven't seen in a couple of years. But that's not how it works. That was always sort of a long shot. And it was, as you pointed out, Steve, it was more based on sentiment than anything else. And now we have the payback from the tariff beating, the front loading of activity last year, plus a whole bunch of other economic problems before we even get to tariffs. And suddenly small business owners are saying, look, we were hoping that things were going well. Now we're thinking we might need to cut back even more in terms of cost. And I think that's what's really got the stock market's attention, and not just the small cap stock. We talk about in the large cap stock space, the AI bubble. Suddenly that's lost a whole lot of its luster too, which is itself a product of facing increasing uncertainty in the real economy as well. So you've got the Russell 2000 as well as the large cap stocks related to the AI bubble. And both of these are starting to signal, at least investors are becoming more and more uncomfortable with the macroeconomic background, because the mainstream thought and conventional wisdom on this seem to have it all backward.
Yeah, Jeff, you mentioned that we should see demand before businesses start to react. And we didn't see that. We saw businesses react. Hey, we're going to build inventory. We're going to do all these wonderful things, because if you build it, people will come. And that's kind of like the housing sector, right? Builders are like, hey, we're super optimistic. We're going to build a ton of homes. And don't worry, people are going to buy. And then what's happening? People aren't going to the stores. They're not buying homes. And all of a sudden, what wasn't supposed to be an inventory recession, and in addition to all the other factors out there, what are we hearing from companies like Nike? Well, our inventories are getting pretty big and we've cut prices, but it's not going down. What are we hearing from companies like Lululemon? Well, store traffic's down. That's not a good sign. And small businesses, they were victims of this because they talked to their suppliers, the wholesalers, and what did they say? Hey, look, prices are going to go up when the tariff hits, so you better buy now and you better buy as much as you can. And they looked at their bottom line and they said, it makes perfect sense. I'm going to buy this inventory at low prices today, and as soon as those tariffs hit, I'm going to mark them up and be like, not my problem. It's all because of the tariffs. And Jeff, they need to do this because they've been hurt at the margin so much. Now the problem is they're ready to raise their prices. They've got all this inventory and people can't afford the prices today. And now businesses are waking up to the reality. And that's what I think we're seeing here in the Russell 2000 is go ahead and raise prices. Demand's going to go down right alongside with your stock.
That's what the most compelling aspect to all this is. It's not one thing or another. It's not one part of one part of the story or another. Like you're saying, Steve, you got all these corporate reports and warnings. We've heard from Target and even Walmart recently, Amazon, the couple that you mentioned. FedEx was another one. I know you talked about that recently as well, saying, hey, look, we're not really happy with what's going on here. But we also have the economic data to back it up. I mentioned in the introduction, the Conference Board's leading economic indicators, which had a big jump last year, as I mentioned. And then they started to plateau, just like consumer sentiment, and then started to roll over. In fact, the Conference Board today, in reporting on its leading economic indicators, actually said consumer expectations of future business conditions turned more pessimistic. That was the component that weighed down most heavily on the index in February. Manufacturing new orders, which Stephen, you and I talked about this before. Manufacturers were going to have a really big adjustment after the demand pulled forward there. But manufacturing new orders, which improved in January, retreated and were the second largest negative contributor to the index's monthly decline. And the Conference Board even noted, even though the index was up last year and was still relatively higher over the last 6 months, they noted how, given the way their components shook out, the LEI actually signaled a recession warning here in February because of the loss of momentum in some of these sectors. So it fits with again, it's not one thing or another. You've got the stock market that's suddenly concerned about macro and more serious in a way that we haven't seen in probably 3 years. You've got all this economic data. We've talked about retail sales before, which is a big one, loss of momentum among consumers, which is going to pressure everybody. You've got companies' warnings. It seems like it's coming in from all directions, which is really what I think has people's their undivided attention. There's a lot of anxiety that people are saying it's about tariffs in the same way last year, like you pointed out, Steve, everybody's saying it was political anxiety. It's really just the same economic fundamentals.
Jeff, what you're saying is people are looking for a bottom, just like the stock market. It's looking for a bottom right now, and it's not finding one because what are workers looking for? They're looking for an end to when their hours are going to get cut. They're tired of seeing their paychecks shrink. And what are businesses looking for? They're looking for when demand's going to stop bottoming now. We heard from FedEx today. It says, look, for several quarters in a row, demand's gone down for shipping, and this is a big problem. And of course, Jeff, you and I know that, shipping companies are a good leading indicator of the economy. And FedEx's comment was, look, if this gets worse, well, it's a really bad omen for the broad economy, and yet there's no signs that it's getting better. And I think that's what the stock market's been looking for, is where's the bottom here? And nobody's got it. Nike doesn't have it, FedEx doesn't have it, the LEI doesn't have it, small businesses don't have it, consumers don't have it, but yet everyone's trying to buy the dip because they think at some point the bottom's coming in soon. But we keep looking at the economic data. We keep looking at any data we can get our hands on, and it tells us that the bottom isn't in. And what small caps are reflecting here is the fact that they're not. And oftentimes, people look to the large caps and say they lead the economy. Jeff, you mentioned earlier in the show, that's not the case at all. They don't reflect the real economy. Keep in mind, where the small caps go, well, the generals will eventually follow.
There's one more, Steve, right? That happened this week. One more that suddenly now says we're not sure where the bottom is either. And that's the Federal Reserve. The FOMC came out with their summary of economic projections. And what did they do? Actually marked down, they trimmed their GDP forecast by 0.3 of a percentage point. Doesn't sound like a lot, but if you watch these SEPs through the years, as I have and as Steve has, 0.3% of a downgrade is, for the Federal Reserve, a substantial downgrade. So even the Fed is now saying, what before they were, strong and resilient soft landing, suddenly they come out on Wednesday and say, we're a little bit nervous on GDP. Remember, the GDP forecasts that come up from the Fed are the absolute most optimistic case that anything can come up with. And so for the Fed to say, we're that uncertain, I'm going to use that term, about GDP this year, we're going to knock down our forecast by 0.3 of a percentage point. And you wonder why the stock market reacted on the day after the Fed meeting and said, oh, wait a minute, what did Jay Powell say? We were all happy about that other stuff, but then everybody stopped and thought about it. And it's like we just said, it's not one thing or another. Now, even the Fed is saying we're not really sure about the economy either. That's the one thing that I think a lot of people were depending upon as sort of the base case. At the very least, as all this uncertainty shows up everywhere else, at least I can depend upon Jay Powell and Christopher Waller and all the rest of them to tell me everything's going to be okay. And suddenly this week they say, well, we're not so sure either.
Well, Jeff, what's interesting is this was one Fred. I'm thinking the Fred database.
Hey, we could throw Fred in here.
Yeah.